Hi everyone, welcome to the wonderful world of budgeting. Alright, so what are the objectives of budgeting? Well, the objectives of budgeting, first is to plan. You have to come up with a budget. You have to decide what your goals are going to be. What are your objectives? What do you want to achieve? Do you want to increase sales by 5%? Do you want to decrease costs by 3%? Alright, so the idea is you're establishing those goals, and those goals are what you're working towards, so it helps you guide the decision making in your business. And then from there, directing is the next task, which is executing those plans then to achieve the goals that you've set for yourself. And then the last piece is controlling. Controlling is comparing the actual results with the budgeted, goals. left a word off. All right, comparing actual results with the budgeted goals. The idea is at some point, you have to step back and say, okay, I made this budget for myself, and this was my plan on where I wanted to go with my business. How did I do? All right, and that's, you'll hear a budget to actual report. That's basically what we're talking about here. It's a budget to actual is a typical financial statement. Well, I hate to say financial statement. It's a typical report a managerial accountant will put together so they can compare the goals. All right, now it doesn't necessarily mean that something went wrong if you don't meet those goals. Maybe there were costs that were unexpected. Maybe gas prices were through the roof. Okay, any one of those things could happen, but the point is if you want to guide your business in a certain direction, at some point you have to step back and say, how am I doing? And that's the controlling piece. Okay, so one of the things when you're creating a budget, and one of the terms in your text is something called budgetary slack. You don't want to make your budget too hard or too easy, really. Right? If you make your budget too hard, right? Like the goals are impossible to achieve. How many times have you been faced with an impossible task and you're like, there is no way. That's completely unrealistic and there's no way that I'm going to meet that budget. If that's the case, you have just set your company up for failure because your people aren't even going to try. All right. The flip side of it is budgetary slack. All right. There's your new term. And what budgetary slack is that you made your budget too easy to meet, right? So what happens if you say it's going to take, 3 hours to do a certain job and it really only takes your employees an hour? What are they going to do? Are they going to do that job, are they going to take the full 3 hours? Are they going to do it really slow? Or are they going to take a 1 hour and then take lots of coffee breaks, right? So the idea is that you don't want to make your budgets too easy to meet either because, human nature, you tend to eat at that time. You hear things like with budgets, use it or lose it, right? That's budgetary slack. You're building in excess. The idea behind use it or lose it is, you're given a certain budget, let's say, and you got extra money at the end of the month and you might be like, well, if I don't use it, they're not going to give it to me again, so use it or lose it. All right, that's where that expression comes from. Okay, so the idea is that you set a normal budget. I feel like the terms are in here. Oh, well, we'll talk about that with variances. Okay, we have a few more conversations to have in another chapter about budgets. All right, what time period in which do you create a budget for? Well, you could go with a fiscal year budget, right? Really, remember, companies don't need to be on a calendar year, but you could do a calendar year, right? So it could be a fiscal year, which means you could do any 12-month period. You could go with a calendar year, January to December, whatever it is. But the idea is that the best practice is to do something called continuous budgeting. And what continuous budgeting is that you're always looking forward. You're looking forward 12 months, right? So it's not like January through December, we did our budget and that's it. We don't look to the next January. We're constantly rolling the budget forward, and that's a really good way to stay on top of things. All right. Couple of systems. This is, I'm grabbing a lot of this right from your book, but I'm explaining it. So if you wanted to read more about it in your book, by all means, it's there. But budgeting systems. Static budgeting. Static budgeting is budgets that don't change based on activity levels changing. And you see that a lot of times with like administrative budgets. So if you were to go to RVCC, of course, right? And you were to look at the business department's budget, it's a static budget. It doesn't matter if I teach more classes or less classes, the activity levels don't change. This is what our budget is for supplies. This is what our budget is for, our administrative staff and so on. Maybe it should go up based on, more students, more supplies, but it really doesn't. It's a static budget. It's just one budget for the year and, no ups or downs, no different activity levels, if you will. And like I said, it's very typical in non-manufacturing budgets. What's typical in manufacturing worlds is something called flexible budgeting. And flexible budgeting shows the results from multiple levels. So let's say you're trying to project and you're saying, what if we make and sell 5,000 units this year? What if we make and sell 7,000 units? What if we make and sell 10,000, 20,000, 30,000? Okay, so the idea is you kind of have all those budgets in a side-by-side comparison, and you'd be able to look at them and say, figure out where you would be based on those different levels of activity. So that's flexible budgeting. It's really having multiple budgets set for all the different activity levels. That may sound like a lot of work, but we've kind of already done a lot of the work. This is why we do that split between variable and fixed budget, variable and fixed costs. A lot of that goes into play with budgeting, which you'll see in a bit. Okay, a couple more terms before we can start getting into some number crunching here. Preparing a budget. You can approach preparing a budget a couple of different ways, but the two main ways are an incremental budget or a zero-based budget. Now, an incremental budget is just increases and decreases by a percentage, as you see here. What that means is, have you ever heard people say, we're going to cut 3% across the board? And basically they're saying they're going to cut costs by 3%, and they don't factor in some costs can't necessarily be cut by 3%. But that's an incremental budget. Or maybe costs are going to go up by 5%, and they prepare a budget based on that. So it's really just kind of applying a percentage or an increment and preparing the budget based on that. It's not a great budgeting technique. What is better to do is something called a zero-based budget. And what a zero-based budget is, it means you're starting basically from scratch every time, right? Starting with zero. Every time you're analyzing what your expenses are, what you expect them to be based on different activity levels, what revenues look like they're going to be. The idea is you're looking more carefully at your expenses and your budget overall. You're looking more carefully at it because you're starting from scratch each time rather than just going with a flat 3%. Now, that incremental budgeting is something we do at RV when we're talking about, like I said, the business department's budget. They do look at it as an incremental budget. They say, we're going to cut everybody by 2% and save the college X amount of money. And they just do it. But really what makes more sense is zero-based, right? Looking granularly at all of the different costs and making sure they still make sense. Okay, so to get into the world of manufacturing here, let me get this off the screen. What we're going to be focusing on, we're going to be looking at the operating budget, and we're going to be doing a lot of calculations based on the operating budget. And what it is you start with a general sales budget right here. And that sales budget, right, the idea is how much do we plan on selling of our product this year? That's our sales budget. And we'll have different activity levels, of course. If I have this many sales, like let's say I plan on selling 20,000 units, well then how many do I need to make? Do I make 20,000 also? The sales budget then drives the production budget. Because you're saying, well, all right, if I'm going to sell 20,000, I need to make 20,000. But are you only going to sell 20,000? Are you only going to make 20,000? Don't you want to have some left over, like inventory sitting on your shelves? What if people, the demand is higher and really you need like 25,000? So maybe the production budget should also have various levels. Okay, so something to think about. And we'll get into the math on all these in a bit. All right, so now, we start with the sales budget, like 20,000. Now we want to produce maybe, let's say, 25,000 units. Well, if I'm going to produce 25,000 units, how many materials do I have to buy? Okay, so now that goes to the purchasing department because their job is to go out and go buy me those materials. How many employees do I need in order to meet the 25,000 I want to produce? That's the direct labor budget. And then you've got the factory overhead budget, which is a little bit wishy-washy because factory overhead is a little bit wishy-washy, right? It's all those various costs that aren't direct materials and aren't direct labor, but are main cost of running your business, running your factory. So with that being the case, we're not going to spend much time on factory overhead because companies all do very many different things, but we're really going to focus on the materials and the labor piece of it because that's a lot more real, more objective. These are easy, straightforward calculations. For this one, maybe a little bit not so much. All right, so because I'm not going to go into explanation on that, yes, it means I'm not going to give you homework on it, nor am I going to test you on it. Let's just get that out of the way. All right, so all of these together, think about it, right? Direct materials, direct labor, factory overhead, all become part of the cost of goods sold budget because we want that all those costs to be accumulated in there. And from there, what we can do is we can prepare an income statement. And that's really kind of our end goal. Well, I'm coming back to that one. But it's kind of our end goal, right? We want to be able to say, if this year goes the way I expect it to, this is how much money we'll make, this is what our income from operations will be, this is what our gross profit percentage will be, and so on. This is what I expect our net income to be. That's the goal, right? We're projecting forward and budgeting our income statement. The other little piece, and you see it follows on the outside here, is selling and administrative expenses, right? Because they don't have anything to do with the actual product being produced, but it is also an important cost. It's an important operating expense that we do still need to be capture, selling and administrative expenses. Okay, so we keep that budget kind of on the side because it's not one of the core calculations here, but it is equally important because it does need to become part of the budget income statement. Okay, how am I doing on time here? All right, so before I start getting into numbers and calculations, that's what we're doing next. I'm going to pause it. We'll start part 2 in a minute.